If you're thinking about moving up to your next home, maybe a bigger place, a better neighborhood, or something with that extra bedroom, one thing that you're probably wondering is how to make the timing work between selling your current home and buying your next one. So, this is a common question from clients. What if you buy first, but your home sells later? How do you come up with a down payment before the proceeds from your current home sale are in your account? Well, that's exactly where bridge financing comes in. So in this video, we're going to unpack exactly what bridge financing is, its pros and cons, and when it would make sense to use it. Hopefully by the end, you'll understand whether bridge financing is a good option for you or if it's a risk that was better off avoided. So let's start with the basics. Bridge financing is a short-term loan that lets you tap into the equity of your current home so that you can buy your new home before the sale of your current home closes. So it literally bridges the financial gap between your purchase and your sale. In a perfect world, you'd sell your home, get your money, and buy your next home all on the same day. But more often in reality, closing dates don't always line up nicely. Sometimes your new home closes before the sale of your current property goes forward, and that's where bridge financing comes in. So here in Alberta, bridge loans are typically set up by either your mortgage lender or your bank. They'll lend you the funds that you need to close, often up to 80% of the equity that you'll have once your sale closes. Then you'll use that to cover the down payment or closing costs of the new property. Now, these loans are short term, usually 30 to 90 days. However, some lenders may make exceptions for certain circumstances. It's important to understand that bridge financing isn't another kind of mortgage. It's a special arrangement that your lender will set up alongside your new mortgage. In essence, you're borrowing against the value of your current home with the expectation that that loan will be closed as soon as the sale proceeds. And in most cases, you won't be making monthly payments on a bridge loan. You'll simply pay off the loan plus interest in full once the funds from your sale come in. So how does it actually work here in Alberta? Well, first, you'll need a firm sale agreement on your current property. That means that all conditions have been removed and the sale is now legally binding. Lenders won't consider a bridge loan if your sale is still conditional or hasn't firmed up. They'll also need a signed purchase agreement for your new home, as both transactions have to be locked in before the bridge can be arranged. Now, once that's in place, your lender will look at your existing home's equity, which is basically the sale price minus any outstanding mortgages or liens, and they'll typically lend you up to 80% of that equity. This gives you access to the funds that you'll need for the down payment on your new home before the funds from your sale actually hit your account. So how do payments actually work with a bridge loan? Well, as I mentioned before, most lenders don't require a monthly payment. Instead, interest accumulates over the term and you'll pay off everything once the sale of your property closes. Keep in mind that interest on a bridge loan is usually higher than your existing mortgage rate. It's often prime plus 2 to 5%. However, there can also be administration fees for setting it up. One other thing to note is that some lenders will also charge a discharge fee once the loan has been repaid. Now, while you won't be paying monthly fees, lenders will still check your qualification credentials to see that you can carry both the bridge loan and the mortgage at the same time. They want to make sure that you're not overextending yourself, especially if the sale of your current home takes longer than expected. So, bridge financing can be a lifesaver in the right circumstances, but it's not without its trade-offs. On the positive side, it gives you flexibility. You won't need to rush the sale of your property just to make the timing work. And you're not stuck making an offer on your next home with a sale of buyer's home condition attached, which can weaken your position. And that's a big one. That can make your offer look significantly more attractive in a competitive market like Calgary. Bridge loans can also give you a lot of breathing room when it comes to things like planning your move or doing minor renovations to your current home. But now for the major drawbacks, bridge loans do cost money. The higher interest rate might not seem like much when you're only borrowing for a few weeks, but if your sale gets delayed for any reason and drags on, then the costs will start to mount. With a bridge loan, you also are taking on some risk. If your current home sale falls through or gets pushed back, you could find yourself in the position of carrying two mortgages plus the bridge loan for longer than you expected. That's why with a bridge loan, it's very important to have a solid backup plan and make sure that you're comfortable carrying the temporary financial load. The other thing you're going to want to watch is lender policy. Not all lenders offer bridge loans, and of those that do, not all are flexible on the terms. Some may have strict limits on how much they're willing to lend or how long they're willing to extend the bridge for. So it's definitely something that you're going to want to have a conversation with your mortgage broker about in advance so that you're absolutely certain of where you stand. So, how do you know if a bridge loan is right for your move? Well, it really comes down to your situation and your risk tolerance. If you already have a firm agreement on the sale of your home and your purchase date on your new home is fast approaching, a bridge loan can make the transition smooth and stress-free. It can also be a smart option if you need to access the equity of your home, say for a large down payment, or to cover the closing costs on your new home before the sale completes. Now, bridge financing might not be the best option for you if you're banking on your home selling in a hot market, but you've yet to get a firm deal on it. Alternatively, if your finances are already stretched thin as it is and you're feeling a little bit uncomfortable, bridge financing might not be the best option for you. The same goes for if you're buying or selling homes in an unpredictable market where closings are prone to delays. In my experience here in Calgary, bridge financing tends to work best for move-up buyers who've already got a solid buyer lined up on their current property and are making a well-planned move. So if that sounds like you, it can be a great tool, but it's definitely not something that you'll want to lean on without first fully understanding the risks and costs involved. So that's bridge financing in a nutshell. It can be a very powerful tool if you're a move-up buyer or if the timing of your sales doesn't line up. However, it comes with its own set of costs and considerations. Like any financing strategy, the key is to make sure that it fits into your personal financial situation and that you're working with the right professionals who can help guide you through the process. If you found this video helpful, please do like and subscribe. It's a big help to a small channel just starting out like mine. And if you have any questions or a personal story about your experience using bridge financing, please drop it in the comments below. Thanks for watching, and I'll see you in the next one.